To understand why Bitcoin holding above $70,000 matters so much right now, we need to step back and look at the broader picture. Bitcoin has been through multiple market cycles. It has seen explosive rallies, devastating corrections, regulatory crackdowns, exchange collapses, and everything in between. Yet here it stands, not just surviving those events, but emerging from each one with a more established market structure, a broader investor base, and a stronger institutional presence than it had before. The $70,000 level isn't just a number. It represents a psychological and technical threshold that carries enormous weight for the market as a whole. Let's start with what's actually driving this current period of strength. Institutional demand is at the center of the story. Over the past several months, we have seen a consistent and measurable increase in the amount of Bitcoin being accumulated by institutions, hedge funds, asset management firms, publicly traded companies, and sovereign wealth vehicles. This isn't the retail-driven frenzy of 2021 where social media buzz and retail speculation pushed prices to previous highs. This is a more deliberate, more calculated, and in many ways more sustainable form of accumulation. When institutions buy Bitcoin, they don't tend to panic sell at the first sign of volatility. They have long time horizons, risk management frameworks, and board-level mandates that guide their positions. That dynamic fundamentally changes the supply and demand equation in Bitcoin's favor. A significant part of what has enabled this institutional wave is the approval and continued growth of spot Bitcoin exchange-traded funds. Since spot Bitcoin ETFs received regulatory approval, we have seen consistent inflows from institutional and high-net-worth investors who previously found direct cryptocurrency ownership too complicated or too risky from a custodial standpoint. The ETF structure gives these investors a familiar, regulated vehicle to gain exposure to Bitcoin's price performance without having to manage private keys or navigate crypto-specific infrastructure. The numbers that have come out of these products since their launch have been extraordinary by any standard, and the trajectory of those inflows shows no meaningful sign of reversing. Week after week, new capital has been allocated into these products, and that capital is directly tied to Bitcoin purchases on the open market. Then there is the supply side of this equation, which is just as important as the demand side. Bitcoin has a hard-coded supply cap of 21 million coins. There will never be more than that, and approximately 94% of that supply has already been mined. But more relevant to right now is what happened earlier this year, the Bitcoin halving. For those who are newer to this space, the halving is a programmatic event built into Bitcoin's code that reduces the reward miners receive for validating transactions by 50%. This halving reduced the rate at which new Bitcoin enters circulation, meaning the supply of newly minted Bitcoin being sold into the market has dropped significantly. When you combine declining new supply with rising institutional demand, the natural consequence, all else being equal, is upward price pressure. That's not a prediction based on sentiment, that's basic economics. Beyond the immediate mechanics of supply and demand, there's a broader macro environment that is creating favorable conditions for Bitcoin. Globally, concerns about currency debasement and inflation remain very much alive. Central banks in multiple major economies have engaged in historic levels of monetary expansion over the past several years. And while some of that liquidity has been walked back through rate hikes, the underlying balance sheets of these institutions remain dramatically larger than they were before. For many institutional investors, Bitcoin is increasingly being considered as a legitimate hedge against that kind of monetary risk. Not a replacement for traditional hedges like gold, but a complementary asset in a diversified portfolio. The fact that Bitcoin is now being discussed in those terms in the boardrooms of the world's largest asset managers is itself a remarkable shift from where the narrative was just 5 years ago. Speaking of gold, it's worth drawing a direct comparison here because the parallels are instructive. Gold has long been considered the go-to store of value asset. It has thousands of years of history as money. It's tangible and it's universally recognized. But Bitcoin, in the view of a growing number of serious financial analysts, has properties that make it an arguably superior store of value in a digital age. It's more portable, more divisible, more verifiable, and its supply cap is enforced by code rather than by the physical limitations of mining the Earth's crust. As that narrative continues to gain credibility among institutional investors, particularly younger institutional investors who have grown up in a digital native world, the portion of traditional store of value demand that flows toward Bitcoin rather than gold is likely to increase. Some analysts have begun referring to this phenomenon as the digital gold thesis, maturing in real time. Now let's talk about the on-chain data, because the blockchain doesn't lie. One of the most powerful things about Bitcoin, and about the transparency of the public ledger, is that we can actually see what's happening with coins in real time. And what the on-chain data is currently showing is a pattern that analysts often associate with accumulation phases and market strength. The amount of Bitcoin that has not moved in over a year, what analysts refer to as long-term holder supply, has been increasing. This means that a growing proportion of Bitcoin's circulating supply is being held by participants who are not interested in selling at current prices. They are sitting on their positions, waiting for higher prices, or simply holding as a form of long-term savings. When long-term holder supply increases while price holds steady or rises, it is generally considered a bullish structural signal. Another important on-chain metric worth noting is the activity on Bitcoin exchanges. Exchange reserves, the amount of Bitcoin sitting on trading platforms, have been declining. This matters because when Bitcoin moves off exchanges, it typically means holders are moving it to self-custody or cold storage, which implies they are not planning to sell in the near term. Declining exchange reserves reduce the available supply that can be sold quickly into the market, which again tilts the supply-demand balance in favor of price stability or appreciation. Taken together with the long-term holder data, the exchange reserve figures paint a consistent picture of an asset whose supply is tightening even as demand from institutional sources grows. Let's also address the regulatory landscape, because it's impossible to talk about Bitcoin's long-term prospects without acknowledging the evolving regulatory environment. Over the past year, there has been a meaningful shift in tone from regulators in several key jurisdictions. In the United States, which remains the most important regulatory market for global crypto, we have seen a more constructive dialogue emerging between the industry and policymakers. The approval of spot Bitcoin ETFs was itself a regulatory milestone that many in the industry thought was still years away. That approval has opened the door to further engagement and has set a precedent that is being watched closely in other jurisdictions. In Europe, the Markets in Crypto Assets Regulation, known as MiCA, has provided a clearer framework for crypto businesses operating in the EU, which has helped reduce uncertainty for institutional participants considering exposure to digital assets. Regulatory clarity, even when it comes with restrictions, is ultimately better for markets than regulatory ambiguity. When institutions know the rules of the game, they are more willing to participate. And as more institutions participate, the market becomes deeper and more liquid, which in turn makes it more attractive to additional institutional participants. It's a reinforcing cycle, and the regulatory developments of the past 12 to 18 months have helped set that cycle in motion more firmly than at any previous point in Bitcoin's history. Now, it wouldn't be responsible reporting to talk only about the positive dynamics without also acknowledging the risks. No asset, not Bitcoin, not gold, not equities, is without risk, and it's important to hold a clear-eyed view of both sides. Bitcoin remains a volatile asset. Even in a period of strength, double-digit percentage corrections can and do happen, sometimes with very little warning. The macroeconomic environment, while generally supportive for Bitcoin right now, is not static. A significant shift in interest rate policy, an unexpected geopolitical event, or a major regulatory development in a key market could create short-term headwinds. The crypto market also continues to face risks from bad actors. Exchange hacks, project collapses, and fraudulent schemes continue to surface and can damage sentiment across the entire asset class, even when Bitcoin itself is not directly involved. Additionally, while institutional adoption is a major positive development, it also introduces a new kind of risk, the risk of institutional herding. When large amounts of capital are managed by a relatively small number of decision makers who are all looking at the same data and responding to the same market signals, coordinated selling or redemptions can create sharper downward movements than the market might otherwise experience. We've seen hints of this dynamic in other asset classes, and it's something Bitcoin market participants should be aware of as institutional ownership grows. Having laid out both the structural positives and the real risks, where does that leave us in terms of the overall market picture? The consensus among serious market analysts is that Bitcoin's hold above $70,000 is significant, and that the underlying fundamentals, the halving-driven supply reduction, the growing institutional demand, the expanding ETF ecosystem, and the improving regulatory environment collectively represent the strongest structural foundation Bitcoin has had at any point in its 16-year history. That doesn't mean prices can only go up from here in a straight line. Markets don't work that way. But it does mean that the case for Bitcoin as a long-term store of value and as a legitimate asset class has never been more credibly argued than it is today. For investors who are watching this space and trying to determine how to position themselves, the key takeaway from the current environment is this: what's happening with Bitcoin right now is not being driven primarily by speculation or hype. It's being driven by capital allocation decisions made at the highest levels of the global financial system. That's a qualitatively different kind of buying pressure than what we've seen in previous cycles, and it has real implications for the duration and sustainability of this period of price strength. When pension funds, sovereign wealth vehicles, and multi-billion-dollar asset managers are adding Bitcoin to their books, they are not doing so because of a tweet or a trending hashtag. They are doing so because their research teams and risk committees have concluded that the asset belongs in a modern portfolio. Looking at the technical picture, the $70,000 level has established itself as a strong area of support. The market has tested this level multiple times and has thus far held, which in technical analysis terms means that buying interest at this price point has consistently outweighed selling pressure. That doesn't guarantee it won't be broken. Support levels break all the time, and technical analysis is a tool for understanding probabilities, not certainties. But the repeated tests and holds do indicate that there is genuine conviction among market participants about the value of Bitcoin at current levels. The longer it holds above 70,000, the more firmly that level becomes established as a base from which the next leg of the move, up or down, will be evaluated. From a broader market perspective, the performance of Bitcoin above 70,000 also sends a signal to the wider cryptocurrency ecosystem. Bitcoin dominance, its share of total crypto market capitalization, tends to influence sentiment and capital flows throughout the entire digital asset space. When Bitcoin is strong and stable, it tends to attract capital that then flows into other parts of the market as investors seek additional opportunities. While CryptoHub focuses today specifically on Bitcoin, it's worth noting that the strength at the top of the market has ripple effects that touch everything from Layer 1 blockchain networks to decentralized finance platforms to tokenized real-world assets. The health of Bitcoin is, in many ways, the health of the broader digital asset ecosystem. Outro. That is your update for today here on CryptoHub. Bitcoin holding strong above $70,000 is not a small headline. It is a data point in a larger story about the growing legitimacy and adoption of digital assets at the institutional level. The fundamentals, the on-chain data, the regulatory momentum, and the macro environment are all, to varying degrees, pointing in the same direction. As always, none of what you hear on this channel constitutes financial advice. The decisions you make with your capital are your own, and they should be made with your own research and risk tolerance as the guide. But what we can do here at CryptoHub is make sure you have the information you need to make those decisions from a position of clarity and confidence. If this update added value for you, consider sharing it with someone who needs to hear it. Subscribe to CryptoHub if you haven't already, and stay locked in, because the story developing in the Bitcoin market right now is one that is far from over.